The era of cheap long-term government borrowing is over. We are witnessing a seismic shift in the financial landscape, a departure from the norms that have defined the past decade. This change has profound implications for governments, investors, and the global economy. For over a decade, governments issued ultra-long bonds at record-low rates, capitalizing on an environment of suppressed inflation and aggressive monetary easing by central banks. These conditions allowed them to lock in historically low borrowing costs for extended periods. But that world has vanished. The confluence of factors that supported low rates has dissipated, ushering in a new era of fiscal and monetary realities. Now, borrowing costs are surging, reflecting a fundamental reassessment of risk in the face of rising inflation and tighter monetary policy. The days of near-zero interest rates are firmly behind us. Investor appetite for long-term risk is fading, as the potential for capital losses in long-duration bonds outweighs the perceived benefits. The uncertainty surrounding future inflation and interest rate movements has made investors more risk-averse, and the assumptions that underpin sovereign debt markets have unraveled. The belief that inflation would remain subdued and central banks would continue to provide ample liquidity has been shattered. Persistent inflation driven by supply chain disruptions, rising energy prices, and strong demand, aggressive central bank tightening, aimed at curbing inflation through interest rate hikes and quantitative tightening, and ballooning deficits, fueled by pandemic-related spending and ongoing fiscal stimulus, have forced a fundamental repricing of risk. Investors are demanding higher yields to compensate for the increased uncertainty and potential for losses. Governments face rising debt service costs as they refinance existing debt at higher interest rates and issue new debt to fund ongoing deficits, crowding out spending on infrastructure, essential for long-term economic growth and competitiveness, and social programs, vital for maintaining social stability and supporting vulnerable populations. Investors burned by losses in long-duration bonds, which are particularly sensitive to interest rate changes, are rethinking traditional strategies, shifting toward shorter-duration assets and alternative investments to mitigate risk and enhance returns. As volatility replaces stability, the bond market is experiencing increased price swings, making it more challenging for investors to navigate. The end of the long bond era is a macroeconomic turning point, signaling a fundamental shift in the global financial order, demanding new approaches from policymakers who must address fiscal imbalances and promote sustainable growth, investors who need to adapt their portfolios to the new environment, and corporations who must adjust their financing strategies to higher borrowing costs. To understand today's upheaval, recall the golden age of ultra-long bonds. In the 2010s and early 2020s, low inflation and sluggish growth led to near-zero or negative rates. As central banks flooded markets with liquidity, investors, desperate for yield, flocked to long-dated bonds, while governments locked in cheap financing for decades. The consensus was that low rates and low inflation would last indefinitely, making century bonds seem prudent. This era bred complacency, with both sides convinced the future would mirror the past. But this belief proved disastrously wrong, setting the stage for today's reckoning. The market's faith in perpetual stability was one of the costliest miscalculations in modern finance. The tranquility of the long bond era was shattered by the unexpected return of inflation. Starting in 2021, inflation surged worldwide, fueled by stimulus, supply shocks, and tight labor markets. Central banks responded with aggressive rate hikes, ending years of easy money. Bond prices plunged, especially for long maturities, as yields soared. The assumption that rates would stay low forever collapsed, inflicting heavy losses on investors in long-duration bonds. The risks of duration, once theoretical, became painfully real. Long-term government bonds, once seen as safe, turned volatile and exposed deep market vulnerabilities. The era's core bet, that low rates were permanent, was decisively broken. The repricing of sovereign debt is a global phenomenon. In the U.S., 30-year Treasury yields have surged above 5%, a level not seen since before 2008. The UK and Europe face similar challenges, with long-term borrowing costs at multi-year highs and weak demand for ultra-long bonds. Japan, once the anchor of low global yields, has begun normalizing rates, prompting Japanese investors to reconsider foreign bonds. As yields rise worldwide, governments face a new higher baseline for borrowing costs. The message is clear. The price of long-term money has permanently increased. Investors now demand compensation for inflation, policy uncertainty, and mounting debt. the synchronized surge in yields reflects a global reassessment of risk. Let's delve into the story of Austria's 100-year bond, a financial instrument that once seemed like a stroke of genius, but ultimately became a stark lesson in the unpredictable nature of the market. This bond, issued by the Austrian government, serves as a cautionary tale for investors and policymakers alike. It epitomizes the dramatic reversal we've witnessed in bond markets over the past few years. What was once a landscape of stable, low interest rates has transformed into a volatile environment, leaving many long-term investments vulnerable. Issued in 2020 at a seemingly attractive 0.85% coupon, this century bond represented a bold move by Austria to capitalize on historically low borrowing costs. The idea was to lock in these rates for an entire century, securing long-term funding at a bargain. At the time, it was hailed as a triumph of fiscal strategy, a testament to Austria's financial acumen and its ability to navigate the complexities of the global economy. Analysts praised the deal, and investors eagerly snapped up the bonds. But as inflation began to soar unexpectedly, and central banks responded by aggressively raising interest rates to combat rising prices, the tide quickly turned against long-duration bonds. Consequently, its value collapsed. A stark reminder of the inherent risks associated with long-term investments in a rapidly changing economic climate. The bond experienced a precipitous decline, losing up to a staggering 75% from its peak value, leaving investors reeling from the unexpected losses. The bond's extreme duration, meaning the length of time until it matures, made it hypersensitive to even slight increases in yields. This sensitivity amplified the impact of rising interest rates, leading to the dramatic value erosion. This inflicted huge losses on investors, particularly those who had underestimated the potential for interest rates to rise so sharply and quickly. Pension funds and other institutional investors were among those caught off guard. The century bond shattered the widely held myth of perpetual low rates, a belief that had underpinned many investment strategies in the years leading up to the inflationary surge. It exposed the inherent dangers of simply extrapolating past trends into the future, especially in the complex and ever-evolving world of finance. As a result, governments around the world have largely shelved plans for issuing new ultra-long bonds, recognizing the heightened risks and uncertainties involved. And investors, now acutely aware of the potential for rapid interest rate increases, are increasingly wary of duration risk, carefully scrutinizing the maturity profiles of their bond portfolios. The Austrian bond is now a textbook warning, a case study in the perils of complacency and the importance of rigorous risk management. It serves as a potent reminder that market paradigms can shift rapidly and brutally, often with little warning, leaving even the most sophisticated investors vulnerable. Believing this time is different, a common pitfall in the investment world, proved exceptionally costly for all involved in the Austrian century bond saga. The bond market has undergone a seismic shift. Investors, once eager to snap up ultra-long bonds, are now showing considerable reluctance. This change in sentiment has significant implications for governments worldwide, who rely on these instruments to finance their operations and long-term projects. The appetite for these longer-dated securities has waned considerably, creating a challenging environment for fiscal planners. Consequently, governments are pivoting to short-term debt as a pragmatic response to the prevailing market conditions. This strategic shift involves a greater reliance on instruments with shorter maturities, reflecting an attempt to navigate the current landscape of investor preferences and mitigate potential risks associated with long-term borrowing. Issuing more treasury bills which mature in a year or less becomes an attractive option. These bills offer a quick and relatively inexpensive way to raise funds, providing governments with the necessary liquidity to meet their immediate financial obligations. And short-dated bonds, with maturities ranging from 1 to 5 years, allows governments to tap into a different segment of the investor base, one that is less averse to shorter time horizons and potentially more willing to accept lower yields. This approach helps avoid locking in high rates for decades, a particularly appealing prospect when interest rates are perceived to be at or near their peak. By opting for shorter-term debt, governments retain the flexibility to refinance at potentially lower rates in the future, should market conditions become more favorable. The U.S., facing its own set of fiscal challenges, and UK, grappling with similar economic pressures, have ramped up short-term issuance, significantly increasing the volume of T-bills and short-dated bonds offered to investors. This strategic decision reflects a calculated effort to manage borrowing costs and maintain access to funding in a volatile market environment. While long-term auctions face tepid demand, often struggling to attract sufficient investor interest and sometimes requiring higher yields to clear. This disparity in demand underscores the market's current preference for shorter-term securities and the challenges faced by governments seeking to issue longer-dated debt. This strategy offers flexibility, allowing governments to adapt to changing economic conditions and adjust their borrowing strategies as needed. It provides a degree of agility in managing debt portfolios and responding to unforeseen events, but increases rollover risk, meaning governments must regularly refinance their debt as it matures. Governments must refinance more often, exposing them to market swings and the potential for higher borrowing costs if interest rates rise unexpectedly. This frequent need to refinance creates a continuous cycle of debt management and a heightened sensitivity to market volatility. A sudden loss of investor confidence, perhaps triggered by concerns about fiscal sustainability or geopolitical instability, or rate spike, driven by inflationary pressures or monetary policy tightening, could trigger fiscal crises, making it difficult for governments to refinance their debt at affordable rates and potentially leading to a spiral of rising borrowing costs and economic instability. Debt managers now face a tough choice, a delicate balancing act between managing borrowing costs and mitigating rollover risk. Lock in high costs for the long term, potentially burdening future generations with expensive debt servicing obligations, or gamble on short-term rates improving, hoping that interest rates will decline in the future, allowing them to refinance their debt at lower costs. The current preference for short-term debt is a calculated risk, a strategic decision made in response to specific market conditions and expectations about future interest rate movements. But it leaves budgets more vulnerable to unexpected economic shocks and interest rate fluctuations, potentially straining government finances and limiting their ability to invest in essential public services. The era of easy, long-term funding is over. The days of readily available, low-cost financing for extended periods are likely a thing of the past. Governments must adapt to a more volatile market, developing more sophisticated debt management strategies and preparing for a future where borrowing costs are less predictable and access to funding may be more challenging. The end of the long bond era has upended investment strategies. The classic 60-40th portfolio, once a safe bet, failed as both stocks and bonds fell together in 2022. Long-term government bonds now show volatility once reserved for riskier assets. Investors face deep uncertainty about inflation, central bank policy, and fiscal sustainability. Many are shifting to short-term bonds for yield without extreme price risk, while others seek alternatives like private credit and real assets. The safe asset is no longer immune to capital losses from rate changes. Managing duration risk is now as crucial as managing credit risk. Investors must be more tactical and responsive to macroeconomic forces than ever before. Rising long-term rates ripple through the entire economy. Governments face swelling interest costs, squeezing budgets and forcing tough choices on spending or taxes. Higher yields on government bonds push up borrowing costs for mortgages, auto loans, and business credit. Homeownership becomes less affordable, and investment slows as capital grows more expensive. The era of cheap credit is over, replaced by tighter financial conditions for all. Consumers, businesses, and governments must adjust to a world where money is no longer easy. The bond market's new reality touches every household and every sector. We've entered a fundamentally different era for global finance. The long bond era's low rates and stability have given way to higher inflation, cautious central banks, and deep uncertainty. Governments must now choose between locking in high rates or risking frequent refinancing. Fiscal discipline and credibility are more important than ever, as markets punish missteps swiftly. For investors, the old playbook is obsolete. Duration risk is real, and active management is essential. The end of cheap money demands new strategies and greater vigilance. This transition will be challenging for policymakers, investors, and households alike. Adapting quickly is the key to managing risks and seizing new opportunities in this volatile world.